Hey everyone, another video here. We're still looking at our property, plant, and equipment chapter. What we're going to talk about in this video is asset exchanges. Now, asset exchanges, when you go through and you read the textbook or when you've sat through a lecture in class, sometimes you walk away and you're scratching your head and you're thinking, oh my God, I have no idea how to do these asset exchanges. And they're really not that bad. 100% of the complexity with asset exchanges surrounds one number in the journal entry that we require for the asset exchange. At its base, at heart, what an asset exchange is just a simple disposition of an asset. The primary difference with an asset exchange is instead of the primary compensation, the main compensation you get back, instead of that being cash, you're getting another physical asset. So when cash or some other type of monetary asset is exchanged for an asset that you've sold, the journal entry is pretty simple. You record the cash that you received, you get rid of all traces of the old asset off your books, the cost and the accum, and then you record the resulting gain or loss, and it's quite simple. When we deal with an asset exchange, there's complexity there because instead of getting cash back or some other type of monetary asset like a note receivable, what we're getting in exchange is another physical asset, which raises a bunch of questions. Now, the first and most important question is, what do I set that new non-monetary asset up for? So in the example we're going to look at in this video, we're looking at a pickup truck that's exchanged for a piece of equipment. So if I'm trading away my pickup truck and I'm getting back a piece of equipment, the question I need to ask is, what do I debit that new equipment for? Should it be the fair value of the asset that I gave up? Should it be the fair value of the asset I got? Should it be recorded at some other value, like the carrying value of what I gave up? And unfortunately, the answer is it depends. Now, later on in this slide deck, I've given you a kind of a decision chart, and we have three options when we're setting up that new asset. But again, all of that complexity, those three options just relate to a single number in that journal entry, that debit to the new asset. Okay. Now, the second question we need to answer is, should a gain or loss be recognized on the non-monetary asset that was given up? And the answer is that at times, yes, you may need to record a gain or loss on disposal even though you haven't received cash as the primary exchange. Okay. Now, to answer the first question, what should we set the new asset up for on our books? Well, the preferred answer is that we need to use something called the fair value standard. And what that means is we want to set that new asset up at the fair value of what we gave up. Okay, so if I traded away a pickup truck and got back a piece of equipment, I would be looking to debit that new piece of equipment for the fair value of the pickup truck that I gave away. That's my primary option. That's option number one. Okay, now if it's determined that that asset's fair value is unreliable or the fair value of the equipment you're getting back is more reliable, then you would use the fair value of the incoming asset. When this exists, when you use the fair value standard, quite often there is a gain or loss that results from the transaction. This needs to be included in net income, and it's just it ends up being a direct offshoot of the journal entry itself. Okay. Now, standard rules apply. You always want to record depreciation up to the date of sale and then record the disposal of the asset. Okay, but again, we want to look at setting up the new asset at the fair value of what we gave up. As I mentioned, there are some exceptions to the fair value rule. One of the exceptions, I've already talked about it, bullet point number 2 there. You would set up the fair value, the new asset at its fair value, unless the fair value of the incoming asset is more reliable, or if you have a situation where neither fair value is either available or reliable, or if the transaction lacks commercial substance, then you might need to use the net book value method. And what you do under that in that instance is you set the asset up at the net book value of what you gave up. Okay. Now, this all probably sounds really confusing at this point. When we get to this decision chart, it's going to make it very, very simple to understand what we're supposed to be setting that new asset up as. Now, I've mentioned this thing called commercial substance several times already in the first couple of minutes of this video, so we should probably define that. And what commercial substance is, the textbook looks at it and they're concerned with the cash flows of the company. So when I exchange this asset, okay, when I exchange my pickup truck for this piece of equipment, I have to answer the question, did my cash flows change in significant, substantial way? Meaning, did the amount, the timing, or the riskiness, or the way in which I earn cash flows change in the future? Or did the new asset provide some type of other benefits like increased efficiencies? So in the example that we've used thus far, where we're exchanging a truck for a piece of equipment, let's pretend that we used to use that pickup truck as in a courier service business. So we would pick up parcels, drive around town, and deliver them to different locations, and we were earning our revenue based on deliveries. Let's say we exchange that for a printing press, a piece of equipment that prints wedding invitations or restaurant menus. Okay? In that situation, commercial substance would exist because we've significantly changed the way in which we earn our cash flows and potentially the timing and the riskiness of those future cash flows. Okay? So commercial substance would exist there. Now, where commercial substance may not exist is when I trade one pickup truck for another similar pickup truck. So I trade my brown pickup truck for a green pickup truck. Effectively, they do the same thing. I still can run my courier business. I still intend to continue to run my courier business. A significant amount of cash wasn't exchanged in the transaction, so there's really no commercial substance there. I really haven't changed my business in any significant way or my cash flows in any significant way. So therefore, no commercial substance would exist, and we would use the net book value method. Okay? In either case, listed above there, the change in cash flows has to be significant. Okay? And the change in which way you earn your cash flows, it has to be a significant change. Okay? So that decision chart that I've been talking about is right here. What I would recommend is writing this down and using this as a guide for when you're trying to answer some of these asset exchange questions. Okay, so I've listed them there. You can see we have three options. We have option 1, option 2, and option 3, and those are listed in the order in which you would want to apply them. So if the transaction has commercial substance, now in many of the questions you look at in your textbook, it will say whether or not commercial substance exists. You likely won't have to decide whether or not it does. Okay, but if commercial substance exists, we want to debit the new asset at the fair value of the outgoing assets, plural. So you can see that I've underlined the S there. So you want to debit this new asset that you're getting, and you want to debit it at an amount that equals the fair value of the outgoing assets. So if you gave up more than one asset, you would need to add the fair values of both of those together. If you gave up a piece of a pickup truck and you also paid a couple $1,000s in cash, you would need to add those two things together. You're debiting the new asset at the fair value of the outgoing assets, plural. Okay. The second option you would choose when commercial substance exists only if the fair value of the outgoing asset, meaning the asset you gave up, you would only use option 2 if the fair value of that outgoing asset was either unavailable or not reliable. Meaning the fair value of the incoming asset was more reliable. So let's say you were giving up an asset that you had custom made. Okay, a piece of equipment that you had custom made, there's only one of it in the world, and there's really no way for anybody to be able to reliably assess that fair value because it's so specific and so unique. If you were exchanging that for, say, a vehicle that you could get, 20 comparable numbers off of AutoTrader and have a very reliable fair value, you would likely use the fair value of that vehicle you were receiving because it's more reliable, because there are measurables that you can compare it against and come up with a more accurate fair value. Okay? That is when you would use option number 2. So when commercial substance exists and the fair value of that incoming asset is more reliable. Okay? Now, option number 3 is when there's no commercial substance. And we're going to use something called the net book value method. Now, in the net book value method, we are going to debit that new asset at the net book value of the outgoing assets. Again, plural. So outgoing assets means all the assets you gave up. We'll set that new asset up at their net book value. Okay? Now you'll see in the left-hand margin here, I've got it written in big bold letters. Regardless of whether you choose option 1, option 2, or option 3 to debit the new asset, that debit to the new asset cannot exceed its own fair value. So let's say we're applying option number 1 and we want to debit, and we're exchanging, we'll go back to the example we started with where we're giving up a pickup truck and we're getting back a piece of equipment. If I'm giving up the pickup truck, and let's say the fair value of the pickup truck is $27,000, and I'm getting back a piece of equipment, okay, regardless of what the fair value is of that outgoing asset, if the equipment's fair value is only $23,000, even though I gave up a pickup truck worth $27,000, I cannot set that equipment up at an amount that exceeds its $23,000 fair value. The reason being is we don't want to artificially inflate the value of these assets and set them up more on our books for more than they're actually currently worth. Because then you're creating a situation where you might need to test it for impairment and impair the value down regardless. Okay? So the debit to that new asset cannot exceed its own fair value regardless of which one of those 3 options you choose. Okay? Now, I put a definition down here, answering the question, what does it mean when I say the fair value or the net book of the outgoing assets, plural? What does that mean? Well, what it means is in the exchange, sometimes what happens is we trade one asset for another, and we also sometimes pay a little bit of cash in that transaction, right? So if you pay a little bit of cash in the transaction, the debit to the new asset is going to be the equivalent of either the fair value or net book value of the physical asset, depending on whether there's commercial substance or no commercial substance, plus the cash that you paid out. So that debit is the fair value of the asset plus the cash you paid, or it's the fair net book value of the asset plus the cash you paid. So when you pay cash, you add it to the fair value or net book value of what you gave up. Now, if you receive cash, it's the opposite. You're going to debit that new asset for the fair value of what you gave up minus the cash received if you're doing option 1. If you're doing option 3 from the decision chart, you're going to debit the new asset for the net book value of what you gave up minus the cash received. So if you pay cash, you add it to the value. If you received cash, you're going to subtract it. Okay? So this is the decision chart I want you guys to use to try and answer these asset exchange questions. But I want you to understand one thing. All of this complexity and everything that we've talked about here might seem super, super confusing because we haven't done a question yet. But I want you to remember that all of this really only gives us one number in the journal entry. There is so much low-hanging fruit and there are so many free marks in a question like this. I always tell my students, I say, take a deep breath, relax, just do a normal disposition of an asset. Worry about debiting that new asset at the end. Leave all the complexity till the end. Just get the free marks. Answer the parts that you know how to do, because at heart, at its base, this is simply just an asset disposition. You're either going to debit or credit cash depending on whether you paid it out or whether you received it. You're going to get rid of all traces of the old asset, meaning you're going to credit the cost and debit the accumulated depreciation. And then you're going to deal with setting up this new asset, which is where we apply all these rules. But there are at least 3.5 to 4 free marks in the question before you even get to that point. Okay? So what I want to do now is I want to take a look at one of those questions. Okay? And we're going to go through all 3 scenarios. We're going to we're going to go through several different scenarios. I apologize. So we have a situation here where Carter Inc. is exchanging a truck for a piece of equipment with Brett Limited. The details are as follows. So Carter Inc. has a pickup truck. It had a cost of $35,000, has accumulated depreciation of $27,000, meaning that it has a remaining net book value of $8,000. It currently has a fair market value of $11,000. In addition to giving that truck up, Carter also paid $5,000 to Brett Limited. In exchange, Brett Limited gave to Carter a piece of equipment that had a $15,000 fair value. Now, we're going to answer several questions here from both companies' perspectives, from Carter Inc.'s perspective and from Brett Limited's perspective. Okay? Now again, you can see I've got your decision chart right here. If commercial substance exists, we set up the new asset at the fair value of the outgoing assets. Or if that's fair value is unavailable or unreliable, we set up the fair value or set up the new asset at the fair value of the incoming asset itself. If there's no commercial substance, we set the new asset up at the net book value of what we gave up. Keeping in mind this caveat right here, the net book value, or the debit to the new asset cannot exceed the fair value of that incoming asset. Okay? So let's do all that, but I'm going to flush all that information out of my head. I'm going to pretend like we've never talked about this before. We've never talked about an asset exchange. I'm going to show you how to get the free marks. Okay? So the first question here says, record the entry for Brett Limited regarding the asset exchange, assuming commercial substance exists. Okay? Now, so what we're worried about is Brett Limited. They gave up a piece of equipment that had this cost, accum, net book value, and fair value. And what they got back was a pickup truck that had a fair value of $11,000 and a cash. They also received cash of $5,000. Okay. Now, one thing you have to keep in mind, and this sometimes helps me visualize the question better, is when I'm dealing with the exchange from Brett Limited's perspective, I could care less what the cost, the accum, and the net book value of the other company was. So I'm just going to change that font to white so we don't even have to see it, because it's irrelevant to me right now. I don't care what the cost and the accum was for Carter Limited for that truck. The only thing that's relevant to me when I'm exchanging for this pickup truck is what the fair value is and what the cash I received was. Okay? So again, they want us to record the exchange for Brett Limited regarding the asset exchange, assuming commercial substance exists. So here's my steps. Step 1, record the cash. It's a free mark. If you got cash back, that's a debit. If you paid cash out, that's a credit. In this case here, Brett Limited received $5,000 cash, so I'm going to debit cash for $5,000. Pretty simple, right? The second step is to get rid of all traces of the old asset. So for Brett Limited, they have a cost on their books of $55,000 and they've got accumulated depreciation of $30,000. Those are two separate accounts on your balance sheet. You need to clear them both out, right? Now, the equipment itself is normally a debit balance, right? So to clear that out, I'm going to have to credit the equipment, right? Because I'm exchanging this, I no longer own it. So I have to credit the equipment for the original cost, which is $55,000, and I want to get rid of the accumulated depreciation on that equipment. Okay, and currently there's an accumulated depreciation of $30,000. So step 1, record the cash. Step 2, get rid of all traces of the old asset. Step 3 is where we finally set up this new asset. Now, I'm going to debit this thing called truck because that's what I'm getting back in exchange. Now, I want you to look at what I have on the screen there. And this is why I said get all your free marks, because typically when I grade a question, the account name is worth a half a mark and the account number is worth a half a mark. So you just got 1, 2, 3.5 marks, and you haven't even had to apply any of the asset exchange knowledge. So even though this can seem tricky, there are a ton of free marks. Don't get worked up. Stay calm and just get those free marks. And now we can apply our theory, right? Now, the theory is because commercial substance exists, we want to set the incoming asset up at the fair value of what we gave up. Now, fair value of what we gave up is calculated by taking the fair value of the asset plus or minus cash. Now, from Brett Limited's perspective, they gave up a piece of equipment that had a fair value of $15,000, but they received back cash of $5,000. So in essence, they only really gave up $10,000 in fair value. Okay? So once again, that calculation, the fair value of what I gave up, and Brett Limited is giving up this equipment, has a fair value of $15,000 minus the cash received, right? Had they paid it, we would have added it, but because they received it, we subtract it. That means that we want to debit the truck for $10,000. Now, before you move on, what I want you to do is I want you to take a look at this debit right here, and you have to make sure that you apply this rule right here. Okay? This debit to the pickup truck cannot exceed its own fair value. So if I come back up here and I look at the Carter Limited line, I can see that that pickup truck has a fair value of $11,000. So when I debit the truck, I need to make sure that this debit right here does not exceed that fair value right there. And since it does not, I'm okay. I don't need to cap that debit. That $10,000 debit is fine. Now what you do is you just finish the journal entry. If you take a look, if you add those up, you'll see that you've got $45,000 in debits. You've got $55,000 in credits, right? So to balance this out, I'm either going to record a gain or loss on disposal. Losses are expenses, so they are debits. Gains are credits, as they are revenues. So in this case here, I need a $10,000 debit, which means I have a loss on disposal, right? You can call it loss on disposal, loss on exchange. Any of those terms are absolutely fine. But the loss is the difference between my credits and all of my debits. So I have a $10,000 loss on disposal. That is how you would record this entry for Brett Limited. Record the cash, get rid of all traces of the old asset, then set up that new asset. And then deal with a gain or loss on disposal at the end. Okay? Now let's practice that again. Let's do it from the other company's perspective. So now we're actually worried about Carter. Okay? So now we're worried about Carter Limited, because the next one says, record the entry for Carter Inc. Regarding the asset exchange, assuming commercial substance exists. Okay, so assuming commercial substance exists. So once again, we're going to apply the fair value principle, but we are now dealing with it from the perspective of Carter. So the cost and the accum and the net book value for the piece of equipment, that's irrelevant to them. We could care less. Okay? We're only concerned from Carter Limited's perspective, we're only concerned with the fair value of that equipment we're getting. But once again, we're jumping the gun here. Let's get the free marks. We're now doing the journal entry from Carter's perspective. And in the transaction, in the exchange, Carter actually paid out $5,000 cash. So my step one is always to deal with the cash. So I am going to credit cash for $5,000. Okay, step one, record the cash. Step two, get rid of all traces of the old asset, which means getting rid of the cost and getting rid of the accumulated depreciation. So I'm going to credit the original cost of the asset, right? And Carter is giving up a truck. So I'm going to credit my truck for $35,000, right? And then I'm going to debit my accumulated depreciation on that truck, which is currently sitting at $27,000. Okay? So I've recorded the cash. I've gotten rid of all traces of the old asset. Okay? Now what I need to do is I need to set up the new asset, which in this case is equipment, right? Carter's trading the pickup truck and getting back the equipment. So I'm going to debit equipment, okay? Now, once again, take a look at what's there. That's 3.5 free marks, and you've done nothing but a basic disposition of asset at this time, okay? Now we need to apply that decision chart, that tree or that little 3-option chart I gave you to figure out what to debit this equipment for. Now, once again, this has commercial substance, so we will debit the equipment at the fair value of what we gave up. But it's the fair value of what Carter Limited or Carter Inc. gave up. So in this case, Carter Inc. gave up a pickup truck with a fair value of $11,000 and gave up $5,000 cash. So I'm going to add that $5,000 cash in, right? Which means Carter gave up a value of $16,000. Now the fair value method says, hey, set up that new equipment at the fair value of what you gave up, which is $16K. But once again, before you move on, we have an overriding rule that says you cannot debit equipment at an amount that exceeds its own fair value, right? Now if you take a look, the equipment, we're trying to debit it for $16,000, but if you come here and you look at the Brett line, that equipment only has a fair value of $15,000. So even though the fair value method is saying we should debit this equipment for $16K, it's going to exceed its own fair value. We're artificially inflating this piece of equipment. We're setting it up at an amount that is greater than what it is currently worth. Conservatism will not allow that. So what we actually have to do is we can't record it as $16,000. We actually have to cap it at $15,000. Okay? That's how that fair value standard is applied. Okay? Now, we've recorded the cash, gotten rid of all traces of the old asset. We've set up the new equipment. We now need to balance this transaction out. If you take a look, you've got $42,000 in debits and only $40,000 in credits. So to balance this thing out, I'm going to need another credit, which means I actually have a gain on disposal. Okay? And the difference is the $42,000 minus the $40,000. So there's your $2,000 gain on disposal. That's how you deal with fair value transactions with commercial substance. That's how you apply the fair value cap. Okay. Now the only thing we really haven't talked about is how do we deal with assets that have no commercial substance. If you come all the way back up here to the top, you'll see that no commercial substance. What we do is we set that new asset up at the net book value of the outgoing assets. Now, most often, when you have no commercial substance, there is not going to be a loss on disposal. There will never be a gain, but commonly there is also not a loss on disposal. The only time you'll have a loss on disposal is when you have to apply this fair value cap. Okay? So most commonly, you should see no gain or loss on disposal, because if you're not commercial or significantly or substantially changing your financial position in any way and you're just exchanging one like asset for another, there really shouldn't be any impact on your balance sheet either. So that's why we typically don't have a gain or a loss on disposal or set up an asset that's really changing our balance sheet at all, right? We typically just set it up at the value of what we gave up, so there's no net effect because there was no commercial substance. Okay, so we're going to do that right now. We're taking a look, and once again, we're going to look at Carter's perspective. We're going to record the entry assuming that no commercial substance exists. But once again, I just start with my standard process. The first thing I do is I record my cash. So I'm going to credit cash because I paid it out for $5,000. Then I am going to credit the cost of the asset, and Carter is giving up the pickup truck, right? So I am going to credit the truck for the original cost of $35,000. Then I want to get rid of any accumulated depreciation that exists on the truck, okay, which currently is $27,000. So I've recorded my cash. I've gotten rid of all traces of the asset, meaning gotten rid of the cost and gotten rid of the accum. Okay. Now I'm at the point where I want to debit the new asset, which is the equipment. Now, if you remember, when no commercial substance exists, they said set up the new asset at the net book value of what you gave up. So when I'm trying to debit the new asset, I want to set it up at the net book value of what I gave up. Now, Carter gave up two things. He gave up a pickup truck that had a net book value of $8,000, and he gave up some cash that had a net book value of $5,000. So in total, Carter gave up $13,000 in book value. Now you have to make sure that that book value does not exceed the fair value of that incoming asset. We're trying to debit the equipment for $13K. The fair value is actually higher. It's $15K. So no adjustments need be made. We are okay at just posting the $13,000 as the debit to the equipment. Now when you take a look, we've got $40,000 in debits. We've got $40,000 in credits. Therefore, there is no gain or loss on this exchange. We just set up the equipment, get rid of the truck, and we go about our business. No gain or loss on disposal. Okay? In a nutshell, that's an asset exchange. If you can keep your mindset and you realize, hey, this is just a basic disposition with one little tweak, and you get all of your free marks, even if you blank and remember nothing about asset exchanges, you're still going to get quite a few of the marks on the question. Okay, so hopefully that helps. If you had any issues, go back, write out write out the questions that I asked that we went through in this example. Try and pause the video, try and do the questions yourself, and then watch the video again and see if that helps. So like I said, hope that helps. I'll be coming up with some more videos shortly. But yeah, that's it for asset exchanges.